it used to be you go venture, private equity, IPO, public markets. I think that stays, and we see it where people are just waiting a lot longer to go public. But at some point, people want that liquidity and monetize it, and the private markets aren't yet that liquid. There's some amount. But I actually think what you're starting to see is public companies being taken private because we invested in a company, InvestNet, and they have $3 trillion in assets by financial advisor platform, right? They need to invest in it. It is hard as a public company to make those kind of investments and say to the street, hey, by the way, this is going to impact earnings for the next 18 months. So they become private, right? And so they were taken private by Bain Capital, and then they'll go public, I think, again. So I think there's going to be this new cycle of pulling people off, doing the investment that needs to happen, whether it's AI investments or whatever, and then going public again.
But do you have a concern on valuations in private markets? I mean, this comes over and over again, but we haven't really seen anything. Maybe real estate went a bit ugly, but there's nothing huge.
Yeah, I mean, one of the concerns, investment grade and even some non-investment grade of private credit is trading at the same spreads as traditional fixed income. Like, so you get no premium for illiquidity. That worries me. That kind of thing, I think. Fixed income markets are priced for perfection at the moment. So, you always have to pick your spots. We have a huge secondaries business. I think that they've deployed this current fund with about a 26% average discount. There's about 70% deployed. And, what I say is, it's not that the valuations are wrong of the private equity. It's that there's not a lot of supply to create liquidity in that market because there's not a lot of secondaries. But that gives you a little bit of a pricing element.